Welcome to the Money Mike Show. Today, I want to help you better understand your credit to put you in the driver's seat on the road to financial success. Credit is a financial necessity. Without it, you probably wouldn't be able to afford a car, furniture, or even a home. You don't have to have perfect credit, but you may be leaving lots of money on the table if you have slow or poor credit. Not to mention, some jobs even consider your credit score as a factor before offering you employment. Let's dissect the different factors that make up your score so we can figure out how to raise your credit score and improve your credit. In the United States, there are three main credit report companies: Equifax, Experian, and TransUnion. There are a few smaller ones out there, but more often than not, creditors are pulling these three reports. Your credit score, or FICO score, was created by the Fair Isaacs Corporation. It is a hypothetical algorithm that is supposed to reflect your credit worthiness. It is based on information found in your credit report in 5 general categories: Utilization Ratio, which makes up 30% of your FICO score, determines how much of your available credit you're currently using. For example, if you have a $1,000 credit limit and you're using $300 of that $1,000, your utilization ratio will be 30%. You generally want to keep your usage under 20% for best rates. Your payment history accounts for 35% of your total FICO score. It is the most heavily weighted category because your credit score is all about if you pay your bills on time or not. It is not a reflection of how much you make or your net worth. To make sure you stay current with all your payments, try implementing my asset allocation strategy. If you haven't already watched that asset allocation video, the link will be in the description below. Length of credit history encompasses 15% of your total credit score. This is one of the most common areas that I see millennials struggle with, as we don't have the lengthy credit history that our parents, friends, or older relatives have. Unfortunately, this is a section you probably won't have much control over. But there are some things you can do to help boost this section. Because it's the average length of credit history, don't close out old lines of credit, even if they're at high interest rates. Try getting added as an authorized user on a parent's credit card, even if you don't personally have a card. This will help your length of credit history if they've had that card for quite some time. The last two sections only account for 10% apiece, but I see people put the most emphasis on these sections. Your credit mix, or total accounts, shows the mix of credit you have. Generally, creditors like to see a good mix of credit because it shows them that other lenders trusted you with their money, so they probably can too. A good mix of credit will be having student loans, a car loan, and even a mortgage, for example. Please note that you should not open up a credit card just so you can get a good mix of credit. The last category, hard inquiries, makes up 10% of your FICO score, and it reports how many times there's been a hard pull in your credit. Every time that you apply for a new line of credit, they are more than likely going to do a hard credit pull, and you will know because they will tell you. They have to get your consent before doing a hard credit pull. Checking your own score online or using an app like Credit Karma does not affect your score. Get in the habit of checking your credit report at least every 6 months. I would recommend you take advantage of free apps like Credit Karma and Credit Sesame. If you find an error on your credit report, you can contact the credit reporting company directly and file a dispute. It is important to make sure that information in your credit report is accurate, as your credit affects almost every aspect of your life. Your FICO score ranges from 300 to 850. Generally, anything under 580 is considered bad credit, and you will most likely struggle getting new lines of credit or be doomed to extremely high interest rates. From about 580 to 620 is poor credit. You may be approved in this range, but still face unfavorable interest rates. Most Americans fall in this range. 620 to 660 is average. 660 to 700 is good. Anything above 720 is considered excellent and will enjoy the benefits of unlimited credit lines and low interest rates. The biggest point you should understand is that because the FICO score falls in ranges, you could have a 622 credit score and get the same approval odds and interest rates offered to someone with a 655. A few small changes to your utilization can lead to massive savings on interest payments over the years. I don't want to lecture you, but I also want to take this time to tell you the importance of using your credit lines responsibly. With great power comes great responsibility. When someone gives you something, especially money, you're obligated to take care of it and pay it back as agreed upon. You should avoid buying things that are not necessities, like designer shoes, makeup, and junk food. If you're new to using credit, I would strongly encourage you only use your credit card for emergencies or to pay your bills. I hope to see you back here for the next episode of the Money Mike Show. We will do a credit repair workshop, and I will also explain how I'm able to use almost all of my creditors' money but still maintain a high credit score from month to month. If you learned anything new about credit today, please like this video, share it with a friend, and subscribe to the Money Mike Show for more helpful personal finance videos. I'm Money Mike, helping you reach a financially free future.